Welcome to Lesson 8 of PSRM Fundamentals Overview, where we're looking at penalties and interest. And we have already encountered P&I, and here we will be looking at it in more detail and the configuration needed to set it up. And we'll be showing how changing a filing dates and other payment dates affects the P&I charges. We will also be adding a waiver which can remove particular types of P&I charges. Understand is that P&I configuration is actually very complicated, and we will not be dealing with every single aspect of P&I. I want you to understand the main concepts, and the main concepts are to understand first of all when do different penalties and charges apply. What is the time period? When do they start and when should they end? And let's look at failure to file first of all. A failure to file penalty is for the fact that you have not filed on time, and you will have to pay that that particular charge if it's an ongoing charge from the moment that the filing due date comes until you actually file the actual tax form. So where do we get the filing due date? We already know that. It normally is taken from the filing period. If I look at the filing period, we have, and it's on a revenue calendar, we will have something called the filing due date. And in our case over here, it's the 15th of April. And if there's a grace date, there might be a couple of extra days for the grace. But generally, the filing due date defines for you when the FTF, when the failure to file start. It's on that particular due date. It's the filing due date which then defines actually when the assessment is created on the tax form, what the date, the effective date of that assessment will be. Sometimes you can override that due date and not use the revenue date which we have on this particular calendar, and if there is such an override, you will find that on the obligation. On the obligation, there's something called override filing due date, and you can override that 15th of April to another date. And again, you can also override the payment due date. We'll see that in a minute. So that is important to understand, that you have charges for failure to file from the moment that you the due date comes until when the actual tax form is submitted. Now, in our case, the tax form was submitted on the end of December, on the 30th of December, if we look at the tax form. And we should imagine, therefore, that if I actually change that date and move it backwards, and I have the tax form submitted on time, that failure to file charge should go away. Okay, so let's just see if that actually is so. Let me change the receive date of the tax form and put it back to the 1st of April. I don't know, it doesn't matter what reason I use. And see how the balance is affected. So if we look now at our financial information, I'm going to refresh it and keep an eye on failure to file penalty. And you see it's gone away. So that makes sense to us. Perhaps you might think, though, why do I still have interest and failure to pay? That's because I changed the date of the submitted form, but the actual dates of the payment still remain the same. And we'll look at failure to pay and interest in a moment, but let's just go back to this. The expectation for the time periods for failure to pay and for interest will obviously be from the payment due date and to the actual payment date. And since we didn't actually change the payment date, that's why we saw those charges still there. Now, the failure to pay can also have an override due date, right, as we saw in the obligation. If I go back to the obligation, as I mentioned before, there's an override payment due date as well. But the basic expected payment due date of the for the paying for your tax form is the same date as you're on the revenue calendar. It's the same due date, the filing due date. So you can override it with dates over here, but the standard is the dates that you have on the calendar. Now, if I actually wanted to go back and affect and change these interest and failure to pay so that they would go away, I could do so. I could change those. I could change those by changing the dates of the payment. So, for example, if I went to my financial transaction for my payment, and you see the effective date is on the 30th of December. If I change that back to the beginning of if I bring that back to beginning of April, I should expect that that will have an effect on the financial statement, the balance. So let me just do display, and you see it hasn't gone away. And sometimes you have to do an update P&I because some P&I charges are not updated automatically, and many are triggered automatically by change of financial transactions and other changes in the system. But some you need to actually do an update. And in this case, we need to update. And here we're recalculating everything. And you will see that now we actually now down to 40. The balance, because those transactions have actually gone away. And what the P&I, what you're actually seeing the whole time is that when I make changes to my financial transactions, P&I is recalculated the whole time and has to be calculated back at the exact dates, looking at all the dates of all the financial transactions and taking into account when they occurred, and then changing them and updating them. So continuously, if I make changes to my financial transactions, P&I is changing the whole time. You can actually even see that if I go to my adjustment for a moment, you'll be able to then see all those related adjustments. You'll see there's so many have been cancelled. Many cancelled transactions because I am continuously making updates to the P&I. So you should understand that P&I is very dynamic, changes the whole time, and any updates that you have in the system, some of them are automatically updated, some of them you need to update manually. But so hopefully you've seen how we change the dates of the tax filing date, and we change the date for the payments, how that affects the P&I. I've now just returned the original example back to its dates because we're going to use these charges in the future. So they've now been placed back to the original date of the 30th of December, and you'll see now again that we have our interest, failure to file, and failure to pay shown once more. So just to show you an example, if we have a filing due date for the 15th of April, and the return comes in a month later, for the month of end of April, half of April, and half of May, you will have failure to file charges. But the failure to pay, which has a different due date on the 17th of April, the failure to pay will only begin then. And then once you have the return file, you will have no more failure to file charges, and you will then have only failure to pay and interest until full payment takes place on the beginning of July. And after that, there'll be no more P&I. Okay, so let me now carry on and show you how the particular types of P&I are calculated. We've discussed about the time periods when they begin and when they end, but how are the individual different penalties created? So if I go back to my application, what I'm going to do is show you the obligation type. And it's the obligation type which is going to determine the P&I calculations. So I'm going to use again our sales and use. If I go to P&I control and I go, you will see that we have an effective dated list here. Here we have just one, and the P&I control are all the rules, control all the rules for calculating P&I. So underneath P&I, you're going to see that we have for sales and use, we have 3 rules, each one 3, one for each type: failure to file, failure to pay, and interest. And let's look at each one individually. First of all, we see that it says a month. This is a business object of monthly charge, and that's exactly what happens for failure to file. We pay a monthly charge. Accrual date is an important concept. It tells me what date of the month do I want to create that charge. And the most important thing perhaps is the calculation basis. What is it based upon? And it's based upon a debt category, and that's the reason why we split our adjustments into debt category, and the charge is going to be based upon the debt category alone. And it will calculate based upon something called a rate schedule, which we will look at in a moment. However, even before looking at that rate schedule, you can sort of understand that we have a concept of not to exceed amount. They cannot exceed more than 5%. So that means that no more than 5% of the debt category will you be able to charge failure to file. Other important thing you see here is something called an algorithm, a pre-processing algorithm, and this is an algorithm which is set to determine if this whole failure to file should be calculated in the first place. Is it applicable? And for example, in this we have a determined failure to file applicability algorithm which says that we will only actually create this charge if it is an original tax form, but if it's an amendment, we won't. And there are many more aspects of applicability that you can define to determine whether you actually want to have this calculation. So the most important part is based upon a rate schedule, as I mentioned, and we're not going to look at detail about rate schedule, but we see it's based upon something called a rate version, and it has different components, and it will calculate. If I look at one of these components, I can open this up, and you will see that we have the actual charge is based upon something called a rate factor. It's a unit charge based upon a rate factor of 0.05, of 5%. So it's a 5% charge, and as we see that it is only calculated up to a maximum of 5% of the total. So anyway, there are many configurations needed in order to create each one of these rules. Just want to give you an overview of the concepts. So the most important concepts here are the calculation basis, what we base the charge on, and in this case it's the debt category tax, and the fact that we charge it once a month on a specific day, and we use a rate schedule which you can look at, and it actually only goes to a specific amount, 5%, and after which it will stop. And we will see that actually is reflected in the charges for failure to file. If I click on that, you will see that there was one charge on the 16th, and that's because the accrual day is the 16th. It's the day after, and it gets kicked in immediately when the due date of filing takes place, which is the 15th. And it calculates 5%, and there's a maximum of 5%, so it only creates one particular charge, and after that it stops because it hits its limit of 5%. Now if I go back to my P&I control, you will see that that is the first charge. If I go to the second one, the next rule, failure to pay, here we have not to exceed 25%, and it's going to be a similar concept as the one we saw before. Also calculating on the 16th, it's a monthly charge, it's a maximum of 25 based upon the debt category tax. It doesn't have a pre-processing applicability algorithm, and has a different rate schedule. And if I look at my charges for failure to pay, you see it as a larger amount, up to 25%. If I click on them, you'll see that we have 1, 2, 3, 4, 5 charges up to 25% of the total. Finally, we have the interest, and the interest is different. It's not a monthly charge. So here it is a simple calculation based upon a rate factor. If I go to that rate factor, you'll see that this is a value of 2%, a 2% charge, I think, annually. And if I go back, you will see that it doesn't have a monthly, and it's actually going to calculate daily interest. And it's based upon not only tax, but also failure to pay penalty. Now, if I look at my financial here, and I look at my interest, you'll see that we have charges every day. I didn't mean for every day, but we have actually every month on the 15th. So you see that we have charges every month on on the 15th. Okay, so that is the interest, and hopefully you've understood overall how these P&I work. So the main concepts to remember are the following. We have applicability algorithms. We saw one for failure to file. We see that the most important thing is the calculation basis, and it's based upon the debt category. And for most types of configurations, we use the tax, but for example, interest is also based upon failure to pay. Accrual date, when we're going to actually create the charges, and the frequency as well. In the case of interest, it's actually a charge basically every month on the day of the month, and actually calculates the daily amounts and adds them together for each particular month. And if it's partial month, it will calculate them for part of the month. So for example, over here, since we ended on the 30th, and then we created again on the 31st, we have different charges coming through, okay, for part of the month. You see this is part of the month. So to summarize, what do we have? We have a obligation which has a P&I controls, and the P&I controls are determine the different rules for P&I. We saw about dynamic credit allocation already in the last chapter, that we allocate the payments. These payments come in and are allocated based upon the debt category priority, which is set on the obligation. And we have seen that as we create financial transactions, assessments, and change the dates, and we can change the due dates, we can change the financial transactions, different P&I adjustments are created associated with assessment, and each one of those adjustments has its own debt category. So that interest, for example, has its interest debt category, and the failure to file has its failure to file debt category. That allows subsequent charges, P&I, to be based upon those debt categories in the next month. So for example, for interest, if it's based upon both tax and failure to pay, the first month there may only be tax, and then the next time there is a failure to pay, and since the debt interest is calculation basis is both tax and failure to pay, then it will be calculated both upon for both months, for both debt categories, I mean. So that is the way it works. Now I would like to actually carry on and show you the concept of a waiver. Now we see we have these particular interest, failure to file, failure to pay charges. What happens if there is a good reason for the tax authority to waive some of these charges? This can be done. So let me show you how we do that. I'm going to go to here, to the main menu. I'm going to go to accounting. I'm going to go down and create what's called a waiver, to waive certain P&I charges. And I'm going to bring up my account, which is already in context, and I can waive different types of charges. I can waive all charges. I can do a specific type of, a particular type of debt category, or I can do it for all of them. And in this particular case, I'm going to decide to waive interest. So what I can do is use interest and say I can also do it for a specific amount of days, or I can do it for a whole period. So let's say if I wanted to do it for interest, I can actually look at my interest charges and say I want to waive interest from, I don't know, from May to November. And let's see how that works. So if I actually create now interest effective dated waiver, I can choose my obligation, which is the first one. I can choose the assessment here, and I can say, you know what, I want to I want to actually begin this and do for these months. Let's say I do not want to have any interest. No interest from April to October. Now again, I should expect to see that the first charges, these charges will go away as a result. We'll see. Oh, but we have to have the effective date must be after assessment's effective date. So I'm going to have to do it from the 16th. Okay. Let's say. So when I create the waiver, it's not actually created yet. It tells me actually which ones existing charges, what will happen. It's pending, and no effect yet will be on my allocation over here. On everything, my interest is still 1674. But now if I activate this, we should see that the balance will have an effect. And if I actually look at display allocation now, you will see that partially there's been a waiving of interest. Okay, so those have been waived. So even though I see all the interest charges over here, okay, we see that partially we've created assessments, financial transactions, negative transactions, which counterbalance the interest amounts. So I see my interest amounts over here, but that for these particular months, they have been cancelled, they've been waived. So that is the concept of a waiver. Now, obviously, I could cancel this waiver. If I cancel this waiver, these charges will then be dropped over here, and an extra 1063 will go onto the balance. I can leave them as they are at the moment. So that is a waiver, and that concludes our summary of penalties and interest.